Okay, let's talk about it. Where should you really be putting your hard-earned money? It's the question every single Indian investor asks. Well, in this explainer, we're diving deep into a decade of data to finally settle the score.
And this is the big one, isn't it? SIP, FD, or good old gold. These have been the top three choices for the last 10 years. But which one actually made your money grow the most? Let's find out. Look, we did the homework for you. We went back, we crunched all the numbers, and we kept the logic simple so you can get clear answers. And trust me, by the end of this, you'll know exactly which one is right for you. And the results? Yeah, they might just surprise you. All right, so let's dive in. First up, we've got to talk about the old guard, right? The two choices everyone knows and trusts, the ones that are all about safety. We're talking FDs and gold.
You know what I'm talking about. The fixed deposit, the FD. It's what our parents and grandparents swore by, the absolute ultimate symbol of financial safety. But here's the real question. Does safe actually mean your money is growing? Let's take a look. Okay, let's put some numbers to this. Imagine you put 1 lakh rupees into an FD 10 years ago. Today, you'd have about 1.8 lakhs. Now, don't get me wrong, that's safe, it's guaranteed, but is that really growth? And this is where it gets really interesting. This is the part they don't always tell you. The average interest you got was, what, around 6%? But guess what the average inflation was? Yep, also around 6%. So your money's buying power, it basically stood still. You didn't really gain anything. And that's before taxes even come into the picture. Ouch. So here's the bottom line on FDs, and it's super important to remember this. An FD is great at protecting your money. It's like a vault, but it's not a machine for multiplying it. All right, let's move on to the other big traditional player, gold. And for us in India, gold is, well, it's more than just an investment, isn't it? It's part of our culture. I love this quote. It says it all. Gold is like a financial seatbelt. And when you look at the numbers, you can see why. That same 1 lakh, if you'd bought gold with it 10 years ago, today it would be worth about 2.4 lakhs. Now that's a lot better than the FD, right? It shows gold really does its job, especially when things get a little chaotic in the economy. But we've got to be real here. Gold is what you call a passive asset. It's not going to send you a check every month. There are no monthly returns, no dividends, no interest payments. It just sits there. Its job is to hold its value and protect you when other things go down. Okay, so we've covered safety, we've covered protection. Now, let's talk about the real engine of wealth creation. Let's get to the main event. Let's talk about the SIP. So what exactly is a systematic investment plan, or SIP? It's actually pretty simple. It's just a way to invest a set amount of money every single month into equity mutual funds. And honestly, this has become the go-to wealth creator for the Indian middle class, for sure.
And this chart, wow, this tells you why. Just look at it. Remember how 1 lakh rupees? After 10 years in an SIP, it's worth around 3.6 lakhs. I mean, that's not just a little bit better. That's double what the FD gave you and way more than gold. The difference is absolutely huge.
But you know, the real magic of the SIP isn't even in that one-time investment example. It's in the consistency. Think about it this way. What if you just put in 5,000 rupees every month? Over 10 years, you've invested a total of 6 lakhs. But what's it worth? Somewhere around 12 lakhs. You literally doubled your money just by being consistent. So what's the secret sauce? Why does it work so well? Well, it's basically 4 things. You've got the magic of compounding, your money making more money, you're benefiting from the overall growth of the market, you build the discipline of investing regularly, and you get something called rupee cost averaging, which is just a fancy way of saying you automatically buy more when prices are low and less when they're high. It smooths out the ride. Okay, we've seen the data, we've seen the winners and losers, but now for the most important question of all. What does this mean for you? How do you take all this information and actually use it? Honestly, it's all about matching the right tool to the right job. It's that simple. Got a short-term goal, like 1 to 3 years away? FD is your friend. Safe, stable, no surprises. Worried about a crisis and just want to protect what you have? Gold is that financial seatbelt. But if you're playing the long game, think 5 years or more, and you want to build real wealth, the SIP is the undisputed champion. And hey, here's the best part. You don't have to pick just one. You can actually create a portfolio, a nice little mix. For someone just starting out, a really solid approach could be something like this: 60% into SIPs for that growth, 30% in gold for that safety net, and maybe 10% in FDs for stability and emergencies. See? You get the best of all worlds.
All right, so we've gone through a whole decade of data. It's time to bring it all home. Let's get to the final verdict, the podium finish. And the results? Well, they couldn't be clearer. Taking the top spot on the podium, the gold medal winner is the SIP, the undisputed champion of wealth creation. In second place, with the silver, we have gold, a fantastic protector with some pretty decent returns. And coming in third, taking the bronze, is the FD. It'll keep your money safe, no doubt, but it's just not going to beat inflation.
So there you have it. The numbers speak for themselves. The knowledge is now in your hands. The only real question left is, what are you going to do about it? What's your next move?